How much is a company worth when the person buying it is also the person trying hardest not to? On October 27, 2022, at 11:47 p.m. Eastern Time, the Delaware Secretary of State's office processed a certificate of merger. X Holdings the Secu, a shell company created 3 months earlier, formally absorbed Twitter Inc. The document was 7 pages. The signature belonged to a lawyer, not to the buyer. There was no ceremony. No press release went out that night. The stock ticker disappeared from the New York Stock Exchange without fanfare. The price was $44 billion. And the man who paid it had spent the previous 4 months in court, trying to escape. Elon Musk did not want to own Twitter, not in July, not in August, not in September. He had made an offer in April, signed a binding agreement in late April, and then, by summer, began constructing a legal argument to void the entire transaction. He claimed Twitter had misled him about the number of fake accounts on the platform. He accused the company of withholding data. He filed a counterclaim in Delaware Chancery Court, alleging breach of contract. Twitter's lawyers responded with a lawsuit demanding specific performance, a legal mechanism that forces a party to complete a deal they agreed to. The trial was scheduled for October 17, 2022. 2 weeks before that date, Musk reversed course again. He said he would close the deal after all. The lawyers filed a joint motion to suspend litigation. The judge granted it. And on that Thursday night in late October, the acquisition became final. $44 billion changed hands. Musk fired the CEO within hours. He fired the CFO, the general counsel, and the head of legal policy and trust. He took the company private. He renamed the parent entity X Corp. And within days, he began dismantling the operational structure of one of the most influential communication platforms in the world. The question that matters is not whether Musk wanted to buy Twitter. It's whether, at that price, the deal ever made sense. Twitter was not the largest social network in the world. It never had been. In terms of monthly active users, it was smaller than Facebook, Instagram, YouTube, WhatsApp, TikTok, and Snapchat. By the time Musk made his offer in April 2022, Twitter reported approximately 238 million monetizable daily active users. Facebook, by comparison, had nearly 2 billion daily users. Instagram had over 1 billion. But Twitter's influence was not a function of scale. It was a function of who used it and how. Heads of state posted policy announcements on Twitter before briefing their own cabinets. Central bank governors used the platform to signal monetary policy shifts. CEOs used it to move stock prices. Journalists used it to break news. Activists used it to organize protests. Courts cited tweets as evidence. Regulators opened investigations based on posts. The platform was woven into the infrastructure of public discourse in a way that user count alone could not measure. That influence had a price. In 2021, Twitter's last full year as a public company under independent management, it generated $5.1 billion in revenue. Roughly 90% of that came from advertising. Brands paid to reach Twitter's audience because that audience included decision-makers, tastemakers, and news consumers who shaped broader cultural and political narratives. But the business model had a problem. Twitter had never been consistently profitable. It posted a net loss in 2020. It posted a narrow profit in 2021, the first in 2 years. The company's operating margins were thin, its growth rate had slowed, and while its cultural relevance remained high, its ability to convert that relevance into sustainable financial performance remained uncertain. That uncertainty did not deter Elon Musk. In January 2022, he began buying shares. Musk accumulated his position quietly. By mid-March, he owned more than 73 million shares, representing approximately 9.2% of the company. That made him Twitter's largest individual shareholder. Under U.S. securities law, any investor who crosses the 5% threshold must file a disclosure within 10 days. Musk filed his on April 4th, 11 days late. The filing itself sent Twitter's stock price up nearly 28% in a single trading session. The board invited him to join as a director. Musk accepted. Then, 5 days later, he declined. On April 14, 2022, Musk made an unsolicited offer to acquire the entire company at $54.20 per share. The offer valued Twitter at approximately $43 billion. In a filing with the Securities and Exchange Commission, Musk wrote, "I invested in Twitter as I believe in its potential to be the platform for free speech around the globe. However, since making my investment, I now realize the company will neither thrive nor serve this societal imperative in its current form. Twitter needs to be transformed as a private company." The board responded with a poison pill, a defensive tactic designed to prevent hostile takeovers by diluting the value of shares acquired by any single buyer. The measure was intended to buy time, not to block the deal outright. Within days, the tone shifted. Musk presented a financing plan. He secured commitments from Morgan Stanley, Bank of America, Barclays, and other institutions for $13 billion in debt. He pledged $12.5 billion in margin loans backed by his Tesla stock. He committed to provide the remaining equity himself, though later filings revealed additional equity investors including Larry Ellison, the co-founder of Oracle, Sequoia Capital, and Binance. On April 25, 2022, Twitter's board unanimously approved the deal. The agreement was binding, or so it appeared. By early July, Musk's public statements began to change. He started questioning the accuracy of Twitter's disclosures regarding spam and bot accounts. The company had long estimated that fewer than 5% of its monetizable daily active users were fake or automated. Musk claimed the real number was much higher. He demanded access to internal data. Twitter provided some information, but Musk's legal team argued it was insufficient. On July 8, 2022, Musk's lawyers sent a letter to Twitter's board stating that he was terminating the acquisition agreement. They cited material breach of the merger contract, alleging that Twitter had failed to provide necessary data and had made misleading statements about the health of its user base. Twitter filed suit in Delaware Chancery Court 4 days later. The complaint was direct. It accused Musk of buyer's remorse. It noted that the market for technology stocks had declined sharply since April, and it argued that Musk was using the bot issue as a pretext to escape a deal he no longer found financially attractive. The company sought an order of specific performance, a court directive forcing Musk to complete the acquisition at the agreed price. The case moved quickly. Discovery began. Depositions were scheduled. Internal communications were subpoenaed. The trial was set for October 17, 2022. An unusually fast timeline for a case of this complexity. Delaware Chancery Court has jurisdiction over most major corporate disputes in the United States, and its judges are known for efficiency. In cases involving specific performance of merger agreements, the court's track record leaned heavily in favor of enforcement. Musk faced a problem. If the court ruled against him, he would be compelled to buy Twitter at the original price. If he refused, he could be held in contempt. The financial penalties could escalate, and his reputation, already volatile, would absorb another blow. On October 4, 2022, 2 weeks before trial, Musk sent a letter to Twitter's lawyers. He agreed to proceed with the acquisition on the original terms, $54.20 per share, no renegotiation. Twitter accepted. The litigation was suspended. On October 27th, the deal closed. Elon Musk became the owner of Twitter. The first executive action came fast. Parag Agrawal, who had been CEO since November 2021, was fired. Ned Siegel, the CFO, was dismissed. Vijaya Gadde, the head of legal policy and trust, was terminated. Sean Edgett, the general counsel, was removed. All 4 executives were let go within hours of the deal closing. Musk took over as CEO. Within days, he began laying off employees. The first wave came on November 4, 2022. Roughly 3,700 workers were terminated, nearly half the company's workforce. Entire teams were eliminated. The layoffs were conducted remotely. Employees received email notifications, often in the middle of the night. Some discovered they had been fired only when they could no longer access internal systems. The cuts were justified publicly as cost reduction. Twitter had been unprofitable. Musk argued that the company was overstaffed and operationally inefficient. He said the platform could function with a much smaller team. But the speed and scale of the reductions created immediate operational problems. Key infrastructure teams were gutted. Engineers responsible for site reliability, content moderation and data security found themselves either laid off or managing workloads that had previously been distributed across much larger groups. Some employees who were initially terminated were asked to return days later when it became clear their knowledge was critical to keeping the platform running. On November 16th, Musk sent an email to remaining staff. The message was titled, "A Fork in the Road." It informed employees that Twitter's work culture would become extremely hardcore. It required staff to click a link confirming their commitment to long hours and high intensity. Those who did not respond by a specified deadline would be considered resigned, with severance. Hundreds of employees chose not to click. They left. And with them went institutional knowledge, technical expertise, and continuity in relationships with advertisers, regulators, and platform partners. The advertising business began to collapse almost immediately. Before the acquisition, advertising accounted for roughly 90% of Twitter's revenue. The platform's value to advertisers rested on two things: reach and brand safety. Advertisers wanted access to Twitter's audience, but they also wanted assurance that their brands would not appear next to harmful, illegal, or controversial content. That assurance depended on content moderation. Musk had criticized Twitter's moderation practices for years, framing them as censorship. One of his stated reasons for buying the platform was to make it a space for what he called free speech. See, in practice, that meant relaxing enforcement of certain policies. Within weeks, previously banned accounts were reinstated. The volume of hate speech, harassment, and misinformation spiked, according to multiple independent analyses. Moderation teams, already reduced by layoffs, struggled to enforce even the policies that remained. Advertisers noticed. General Motors paused its advertising on the platform the day after Musk's acquisition closed. Volkswagen followed, then Audi, then General Mills, Mondelez, Pfizer, and United Airlines. The list grew. Some companies cited concerns about brand safety. Others pointed to uncertainty about the platform's direction. In late November 2022, Musk spoke at the New York Times DealBook Summit. A reporter asked him about the advertiser exodus. Musk's response was blunt. He said, "If somebody's going to try to blackmail me with advertising, blackmail me with money, go f yourself." The comment was widely circulated. More advertisers left. By the end of 2022, Twitter's advertising revenue had declined sharply. Exact figures were not disclosed as the company was now private, but internal reports later obtained by news organizations indicated that revenue in the fourth quarter of 2022 was down by more than 40% compared to the same period in 2021. The trend continued into 2023. Full-year revenue for 2023 was estimated at approximately $3.4 billion, a decline of more than 20% from 2021. In 2024, revenue fell further to roughly $2.5 billion. UK financial filings released in early 2025 showed that Twitter's British operations experienced a revenue drop of 66% in the year following the acquisition. Updated filings in 2026 revealed another decline of 58% in 2024. The platform's brand value, as measured by independent valuation firms, fell even faster. In January 2022, before Musk's involvement, the Twitter brand was valued at $5.7 billion. By 2023, that figure had dropped to $3.9 billion. In 2024, it was estimated at $673 million, a decline of nearly 90% in 2 years. Musk attempted to offset the advertising losses by building subscription revenue. In November 2022, he launched Twitter Blue, a paid subscription service that offered users a verification badge, the ability to edit tweets, and other features. The service cost $8 per month. Musk framed it as a way to reduce Twitter's dependence on advertising and to democratize verification. The rollout was chaotic, because the blue checkmark had previously been used to verify the identity of public figures, journalists, and organizations. The decision to sell it created confusion. Impersonation accounts proliferated. Fake accounts posing as major companies posted misleading information. Eli Lilly's stock price dropped after a fake verified account tweeted that insulin would be free. Twitter paused the service, then relaunched it with modifications. Subscription uptake was limited. By early 2026, Fewer than 2 million users worldwide were paying for Twitter Blue, according to estimates based on available data. That represented less than 1% of the platform's user base. Even at peak adoption, subscription revenue was generating only a small fraction of what advertising had contributed before the acquisition. Musk also pursued other revenue experiments. He introduced longer video uploads for paid users, explored partnerships with content creators, and discussed plans to integrate payments and financial services. He rebranded the platform from Twitter to X in July 2023, signaling an ambition to build what he called an everything app. None of these initiatives materially reversed the revenue decline. The financial structure of the acquisition compounded the pressure. Musk had financed the $44 billion purchase with a mix of equity and debt. Roughly $13 billion of the total was in the form of loans taken on by Twitter itself. That debt carried interest obligations estimated at over $1 billion per year. Before the acquisition, Twitter's revenue was approximately $5 billion annually, and the company was only marginally profitable in its best years. After the acquisition, with revenue falling and costs rising due to debt service, the company's cash flow came under severe strain. Musk reportedly injected additional capital from his own resources and from co-investors to keep the platform operational. He also sought to renegotiate terms with lenders, though details of those discussions were not made public. By mid-2024, valuation estimates for X had fallen sharply. Fidelity, one of the investors in Musk's acquisition, marked down the value of its stake by nearly 70%. That implied a valuation for X of roughly $15 billion, less than one-third of the $44 billion Musk had paid. Internal documents reviewed by journalists in 2025 suggested the company was generating far less revenue than needed to service its debt and sustain operations at the previous scale. Some creditors reportedly began exploring options for restructuring. The geopolitical dimension added another layer of complexity. Twitter, as a US-based platform operating globally, had always faced regulatory scrutiny. Under Musk's ownership, that scrutiny intensified. The European Union opened investigations into whether X was complying with the Digital Services Act, a new regulatory framework governing online platforms. Regulators in the UK, Australia, and Brazil raised concerns about content moderation, data protection, and misinformation. Musk's public statements, often made on the platform itself, sometimes clashed with the positions of governments and regulatory bodies. That created friction, and in some cases, formal enforcement actions. In Brazil, a dispute with a Supreme Court justice over the suspension of certain accounts led to a temporary ban of the platform in 2024. In Australia, regulators threatened fines over the platform's handling of violent content. In the European Union, Musk faced the possibility of penalties that could reach up to 6% of global revenue if violations of the Digital Services Act were proven. These conflicts were not just reputational, they carried financial and operational risk. A platform banned in a major market loses users, revenue, and relevance. A platform facing multi-billion-dollar fines faces solvency questions, and those questions were being asked. The acquisition of Twitter did not follow the script that most large-scale tech deals follow. There was no integration plan, there was no transition period, there was no effort to preserve institutional continuity or to reassure stakeholders. The buyer had publicly tried to escape the deal. The execution was abrupt, the strategy was improvised, and the cost was measurable. Revenue fell by nearly 50% in 2 years. The platform's brand value collapsed. The debt burden became unsustainable. The advertiser base fragmented. The regulatory environment hardened. The user experience became more chaotic. The workforce was decimated. Musk retained control. He retained influence. He retained the platform's infrastructure. But the $44 billion he paid did not translate into $44 billion of value. Independent valuations placed the company's worth at less than one-third of the purchase price within 2 years. Some analysts suggested it was worth even less. The gap between price paid and value retained became one of the widest in the history of leveraged buyouts. The deal was not illegal. It was not fraudulent. It was not blocked by regulators. It was completed. It was binding. And it destroyed value. Elon Musk bought Twitter because he wanted to control it. He wanted to shape its policies. He wanted to redefine its culture. He wanted to test his vision of what a social platform could become. Those motivations are documented. They are not speculation. But control is not the same as value, and vision is not the same as execution. The decision to acquire Twitter at $44 billion was made in a moment of liquidity, confidence, and public influence. The decision to complete that acquisition, months later, was made under legal compulsion, and the decisions made after the acquisition, rapid, disruptive, and ideologically driven, were made without the buffer that profitability, cash flow, or operational stability typically provide. The result was predictable in retrospect. It was not inevitable, it was chosen, and it became the decision that cost billions.